Ladies and gentlemen, good evening. Allow me to start first with some information, some definitions, a brief about the private equity industry before I introduce my guests. As you know, private equity is a source of investment from high net worth individuals and institutions for the purpose of investing and acquiring equity ownership in private and public companies. Many private equity firms conduct what is known as leveraged buyout, i.e., when large amounts of debt are issued to fund a large purchase. Private equity funds are long-term investors who act with one of the two objectives. First, to develop innovative portfolio companies with high growth potential and to increase the value of their portfolio companies. The size of the private equity market has grown steadily since the 70s, and as per some experts, a record number of private equity firms were born in the year 2015. In a cross-country data, there is a clear positive relationship between private equity investment activity and economic growth. Some researchers argue that the management buyouts played a catalytic role in helping to restore the US economy during the 80s and the early 90s. Recent studies in Europe show a positive effect of private equity and leveraged buyouts on individual firm performance, their productivity, and innovation. Other research shows evidence that firms supported by private equity funds have more robust corporate governance practices than other firms. Today, we're lucky to have three finance experts who would share with us their views on the current situation of the private equity market in Lebanon and the region. I'll start with Mr. Wassim Hneine on my right hand, Managing Director at Emerging Investment Partners with a large number of years of experience in the investment banking industry. Mr. Thomas Jacobs, who's been with us here in Lebanon since 2008 and responsible for overseeing IFC's activities in Lebanon and Syria, as well as their programs in mitigating the effects of climate change in the GCC. And finally, Mr. Wael Zein, Chairman General Partner of Lucid Investments, with more than 25 years of experience in the investment banking industry and private equity in the US, UK, and the GCC. We will start first with a presentation of Mr. Wael Zein of the private equity stakes in our region, and then after that we're going to move to some Q&A session with our guests. Mr. Wael, the floor is yours.
Thank you. Good afternoon, ladies and gentlemen. Thank you, Dr. Chahine, for the introduction. I'm going to share with you today some insights, some practical insights from the private equity industry in Lebanon, with also what private equity would require to see in companies to invest in. This is the focus of our presentation today, with basically the focus is going to be on middle market rather than startups or venture capital. It's going to be focused very much on middle market. To start with, I'm going to do a quick intro about the market, a quick market brief in the region, in the MENA region. You see in 2013, in terms of fundraising level, 744 million were raised for private equity. The average deal size was around 15 million. There were around 66 investment and 16 number of exits. In 2014, the level of fundraising increased to 1.2 or 1.3 billion dollars. The deal size the average deal size was 32 million. Number of investments 72, and the exit is 20. In 2015, it's expected the average deal size is still not determined. There will be around 78 transactions, and the total funds to be raised around $1.5 billion. These $1.5 billion are spread over a number of sectors, around 44% in the services and education, oil and gas 27%, manufacturing 11%, F&B 8%, healthcare 4%, and retail 2%. IT only 1%. If we look at the number of deals, 15 deals in the services and education. If you look at the IT, for instance, you can see that 24% in terms of the deals were in the IT sector, although in terms of size, they were only 1%. And this indicates the small tickets that are invested usually in IT deals. Let's see who are the players, who are the regional players, what countries are leading this, and where is Lebanon in all of this? UAE is leading. It's in the first place with 59% of investment value. Saudi Arabia came second with 21% of investment value. Lebanon came in the 8th place with only 1% of investment value. But what is interesting, let's see in terms of number of deals. UAE is still first with 21% of investment deals. Saudi Arabia came 4th place with 10% of the number of investments, and Lebanon came 3rd in terms of the number of deals with 13% of the number of investments. Obviously, this means that the size of the tickets in Lebanon were very small in order to get these results. If we zoom in on Lebanon, basically 2014, what deals have closed in 2014? We start in January. You see there were like 2 deals, MBC Ventures with Anghami, and the Building Block Equity Fund with Fadil Partners for $1 million. The deal with Anghami, the size of the deal wasn't disclosed according to Zawiya. In June, 2 deals happened. The first was a real estate deal with Markaz Real Estate Opportunity Fund, it's Convivium 7. It's a real estate deal. And then the deal that we have done with Lucid Investment, which is a leveraged buyout in Kababji. It's a $25 million deal. And in fact, in terms of private equity, it was the biggest deal that was closed last year. In August, we had also MBC Ventures with Anghami. And then in October, 5 deals were closed, ranging from 1.5 to 4 million by Impact Fund to a number of companies. And in December, another two deals for Shahia.com. The largest was 14 million by MEVP. If we look at this, most, if not all of those deals were funded by funds that have benefited from the Central Bank Initiative 331. I'm sure you've heard about the Central Bank Initiative 331. It's an initiative whereby Central Bank has provided around 75% coverage for banks to use part of their equity to inject in directly or into funds to be able to be used to fund some transactions in Lebanon. And most of these have been using and benefiting from this 331, which is primarily geared towards small companies, startups, venture capital, and primarily in the knowledge economy with a lot of technology component in it. But if we look at the deal that we have done with Kababji, this is far from being in the VC, etc. This is typically a middle market deal. That's what we are going to discuss today. We're going to focus on this. Who funded the fund, the Kababji fund that we have established? Those are actual investors, high net worth individuals who are driven by return, and they have basically contributed to this fund. This means that they were not covered or subsidized or supported by any government initiative. If we look today at the middle market is a big pillar in the Lebanese economy for all the reasons we know. That's why, but at the same time, middle market have been companies in the middle market have been funded either by capital, personal capital, or by leverage from commercial banks. And this is not the right financing, especially for companies that are looking to grow. And they definitely need equity to grow and to benefit from all the potential and realize all the potential that they have to develop themselves in Lebanon and in the region. That's why we feel that it is the middle market deserves support, deserves another 331 initiative to be able to channel funding into funds that will invest in the middle market, because it is as important, if not much more important, than the startup, etc. It's something that I had to say because it's very important, and we know how difficult it is to fund companies in the middle market. Today, what I'm trying to share with you is actual experience. We are fund managers. We are investors. We are investment bankers and direct investors. We are going to share with you what we look for and what our investors look for in companies. That's why a certain support, similar to the C31 initiative, would be very helpful to fuel this market that is gaining ground slowly in Lebanon. So what do PE firms look for in a target company? This is the core of my presentation today. And I don't want, whatever I'm going to say now is real, and it's mandatory. I don't want to make it look mission impossible to fund middle market companies by equity or by funds. But at the same time, I want to be very realistic and to show what investors look for. The first is return, obviously. Investors, people ask me, is there liquidity in the market? Yes, there is liquidity. Does this mean that investors are going to invest easily in every concept? Absolutely not. Why? Because investors have choices. What are the choices that they have? I mean, an investor, the risk return, we all know that. Investors can invest in a simple 10-year Lebanese Eurobond and have a yield of 6%, or they can have invest in an S&P 500 10-year average. The last 10-year average was around 9%. And these are S&P companies. These are listed companies in the best economy in the world. So they can get a 9% return. So if you come and ask any investor or fund per se, what do you require? They will tell you, we would require something like 20% plus to be able to accept to invest in a certain company. Now, what does this mean? If we look these are some examples of funds that are today in the market, and you can see the promised return ranges from, you have some 20, sometimes 25, and sometimes 30%. So this is the range of expected return that investors look for, and hence private equity firms. This is, I want to focus a little bit on this slide. And if you can see here, if this is an example that will tell you a lot. If a private equity is coming into a company and to buy a stake X in a company for $10 million, as you all know, funds, they have expenses. A normal expense is 3% to incorporate a fund. That's a cheap cost to incorporate a fund. Then you have all heard about the 220 fund fee structure, which is 2% management fee per year for the fund managers to do their job and create the value that they need to create. And of course, all fund managers, they are in this business because primarily for what they call the exit fee or the performance fee or the carry. So in other words, what I'm trying to say here, I'm assuming here this is a company that pays dividend, okay? Because this eases up the situation. If this is a company that pays dividend, you should exit, we should be able to exit in year 5 at 25 million. This means at 2.5 times. So there is no way you can have an investor coming in or a fund coming in unless your company can grow to be sold after 5 years or partly sold after 5 years at 2.5 times the multiple. This is the only way, after taking out all the expenses, this is the only way investors can get the 20% IRR. This is, of course, assuming that we are exiting in year 5. What if we want to exit in year 6? We were not able to find an exit in year 5, and we want to exit in year 6. In year 6, you need to exit at 30 million. It means 3 times the size of the investment to get the 20% IRR. If you want to exit in year 7, you have to exit at a value of 35 million, which is 3.5 times the multiple. So this gives you an idea. Let's move today to another example. Another company, same investment size, but this company doesn't distribute dividend. The situation is going to be more challenging. Without dividend, it means the fund should be a little bit bigger to cater for expenses of the fund. And this means to realize a 20% return, you should be able to exit at 3 times after 5 years, which is 34 million, or 3.75 times after 6 years, and 4.5 times after 7 years. So as a summary here, if we look here, if you want to convince an investor for direct investment or private equity fund to come and invest in your middle market company in Lebanon, you should have a certain vision, you should have a certain strategy that can grow your company to a point where you can exit at these types of multiples, depending if you are distributing dividend or no, after 5, 6, or 7 years. So that's the first important conclusion. 2.5 to 4.5, this is the number that you should keep in your head. This is how much my company should be able to create value. Now we come and ask the question, who is going to create the value? Me, the company alone? Absolutely not. The company should have a certain concept, should have a certain competitive advantage to be able to grow. But this is where the private equity comes to play, and I'm going to also discuss about all the added value services that a private equity investor can add to help you increase the value of the company and reach such multiples and prepare the company to be sold after 5, 6, or 7 years. So this is exit value. The second point, okay, so very good. I want to reach that point. Now we understand this. But what are the components? What are the parameters of the exit value? And exit value, I'm sure you've all seen this before. It's multiple of EBITDA. So my company is selling at 7 times EBITDA. My company was sold at 8 times EBITDA, etc. This is a very common proxy for valuing companies at entry and at exit. Okay. Arithmetically, for those who are interested, this is a kind of reflection of DCF, but I'm not going to get into this discussion now. The multiple of profitability of my EBITDA or my net income is a very important component or a proxy for valuing companies. So there are 2 components, profitability and the multiple. What drives profitability? We should be able to reach at the exit is sustainable revenues. Sustainable revenues means revenues that are growing at a certain pattern with as little fluctuations as possible. Fluctuations in revenue do not help valuing companies. The second is profit margin. Profit margin, I mean, we should be able, after 5 or 6 years, to be able to reach profit margins that are competitive vis-à-vis the industry that we are working in. The fixed cost structure. Fixed cost structure, again, after 5 or 6 years, we should be able to take the company to reach the stage of economy of scale. Third, of course, the finance cost. Finance cost, after 5 or 6 years, should be leverage cost. It should not be an integral part of my capital, because by that time the company is creating value and creating cash flow, and its capital structure became healthy, and using debt could be for leveraging the company and increasing IRR rather than funding the company. Tax-friendly structure, obviously, and this is very common, especially with all the companies that are growing outside. There are many structures in Lebanon, outside Lebanon, that can help reduce the tax and hence preserve your cash flow. The second side is the multiple. What drives the multiple? Profitability is easy, it's arithmetic. But what drives the multiple? For the multiple, the further growth potential at exit. So if we reach at year 5 or 6, the buyer should see that the company still has another potential to grow. This is important, and this determines a lot the multiple, whether it is 6 or 7 or 8 or sometimes 10 or 11 or 12, depending on the deal and the market we're working in. The second is governance. Governance, and this is one of the main issues that we are facing in Lebanon in the middle market. Governance, financial transparency, etc. You know what I'm talking about? It's starting from board practices, authority matrix, financial transparency, one set of books, credible external auditors, etc. I mean, all of that is very important. You can never sell your company after 4 or 5 years if these things are not fixed. And this is something PE firms would tremendously add value during the journey with you. Performing independent management. Especially when you are also planning to sell with the PE, we see that companies that we enter with, they would like us to help them exit with us. You cannot exit if the management is linked to the owners. So you need to prepare your management to be performing and to be as independent as possible. Brand recognition is very also important. Every concept, one of the main attractions for a company is the X factor. Does this company has the X factor, has the brand, has this differentiating factor or competitive advantage? By the year 5 or 6, this X factor should be established and spreading. Financial transparency, I mentioned that. Scalability and ease of adaptation, it's very important, depending on the industry we're working in, of course. Example, in F&B, it's so important. This is a very important factor. You cannot go into any country if your concept cannot be scalable and easily adaptable from menu to size to etc. Exit value, then now we know what drives exit value. But let's say we reach year 5 or year 6, we have very good valuation. We hire one of the top 4 audit companies, and they can prepare a very good valuation for us, and we get a very, very good value that we're happy with. But does this mean that I can actually sell my company? My third point and last point here is marketability at exit. What drives marketability at exit? Marketability is driven by 2 big factors. One, the intrinsic characteristics at exit, which is very important, and the second is the strategic fit. Intrinsic characteristics at exits, we have covered that already. Again, it's the governance, management, brand, scalability, transparency, and very important, cash on cash at acquisition time. When I come to sell my company at year 6 or year 7, if my company is valued at 40 million, I want to also look at my net income. What is the cash on cash ratio at time of exit? This is important for the buyer. The buyer at that time, buying this company at this mature stage, they would like to see certain profitability and certain cash flow. It cannot be another turnaround situation after 5 or 6 years. That's what I'm trying to say. On the strategic fit, we have to find a buyer. Finding a buyer is not easy. This is not a public company. So many factors increase the chance of marketability of the company. One of them is increased market penetration. A buyer would want to increase its market penetration, and they can find that acquiring this company is the easiest way to do that. Another buyer might be interested to have what we call horizontal acquisition. Horizontal acquisition is to grow within its own market. Let's say in the F&B industry, they want to grow in the F&B industry. Other buyers are interested to achieve vertical integration. So we call it vertical acquisition. Other buyers will buy the company to achieve more economies of scale because they know they can use the shared resources. buyers also are interested to overcome barriers to entry. Sometimes, let's say a company that produces cotton in a certain continent, and they are present, let's say, in many countries, it is extremely difficult to replicate this. And the barriers to entry in such industries is extremely high. So a buyer would find it much easier to come and actually buy this company and move forward and enter the market. Obviously, diversification. Increased size of revenue and profitability value. There are many groups, especially in the GCC, that are listed, and these groups from time to time sell components of their businesses. They like to replace these components by other components to keep the same level of revenue and to keep the same level of profitability. These are also potential buyers. Last but not least, expertise and reach. So what I want to say here, there are two important things I would like to conclude with. The first is, all these things that I've said, they look horrifying. I say, wow, I should be able to basically have all of this. No, that's not what we are saying. What we are saying is these are very important parameters that you should consider seriously when you are rethinking your vision and the strategy to achieve this vision. That's number one. Number two, is there help to prepare a company to become fundable by direct investments or by private equity? Absolutely. Specialized investment banks, that's what they do in their advisory department. They work with the company to look into their strategy and to help them get prepared to become fundable by private equity. This is what we call pre-transaction phase that we usually do. Many companies approach us with the aim of getting some funding. We convince them that they need to wait probably a year. So we work closely with them to prepare them. We put them on the catwalk to make sure that they are ready to be fundable at good valuations after 1 year. Other companies are ready. We just engage and start adding value in order to reach these levels. Again, what I'm trying to say here, all my focus is on middle market. And middle market is a very important pillar in the Lebanese economy. And we have many creative companies in many industries. Maybe we can talk about them later during the Q&A session. It is very important for these companies to get their proper chances to get the right funding, not the bank funding, because it's not healthy. And this is very much encouraged by the central bank to deepen the capital market, the private capital market in Lebanon, to provide additional equity funding for companies, to have investors to come share risks, and to have private equity firms to not only share risk and add value in order basically to advance with the companies forward. Thank you.
Thank you, Mr. Zein. Thank you for this comprehensive presentation. Allow me to start with one statistic, and it comes from the US. Over the period 95 to 2013, companies that are backed by private equity increased job creation by about 83%, when the other companies increased it by 27%. This gives a significant role to private equity in developing economy. I'll start by asking a question to Mr. Hneine. Mr. Zein mentioned that Lebanon ranks 8th in the region in terms of value and 3rd in terms of number of deals. What is needed for us to increase the number of deals, to increase the investment and become competitive in our region?
The first thing we should know that private equity in the region is still nascent industry. So it started probably mid-90s, end of 90s, and it's now more and more growing. I think PE industry in Lebanon will have good days ahead, because we see some good jewels in Lebanon in terms of companies that have a solid product, very high quality shareholders, strong management. So the pipeline is there. The pipeline is there, but there is not enough track record of private equity houses. So we need to see track record, meaning investments and exits and IRRs generated. So one thing is track record. Another thing is we need to see management teams. There are not enough management teams covering Lebanon. Probably less than 3 or 4 funds have Lebanon on the radar screen, whether local funds or regional funds. So, and this is, I think, the intention of the FIs, of which is IFC, EBRD, EIB, is to invest in first-time managers to create or to increase the number of PE players in the market and to create liquidity. And we need funds. We need funds because today there's no way one can create a $50 or $100 million fund solely from high net worth individuals. And this is, I think, Wael is referring to a 331 for SMEs, which is, I think, a very good idea to have the public sector contributing with the private sector to the development of SMEs. So this is basically it. It's a track record, management team, funds flowing locally and from abroad, and most importantly, pipeline which is already existent.
Excellent. Thank you, Mr. Hneine. Tom, we heard a presentation about the business model of private equity. You at IFC, how do you differentiate your work from the one that is run by private equity funds?
Thanks, Salim. And for those of you who may not be familiar with IFC, we're the private sector arm of the World Bank Group. So we invest and advise the private sector for development purposes, which is really the key differentiating factor between a developmental financial institution like IFC or EBRD and a pure for-profit commercial PE firm. Now, IFC, we act at times like a PE firm. We take direct equity stakes. Other times we act like a bank and we'll lend directly to companies. But what our real aim is and our purpose is really to promote economic development and to make sure that the citizens in the countries where we operate are benefiting from the investments that we make. Alongside of that is we have to make a commercial return commensurate with our commercial risk, in line with what Wael was describing. So everything that he was saying is something that IFC takes on board. But one thing he didn't mention, which IFC would focus on, is what is the developmental impact of each investment and what is the role of IFC. One of our key mandates is not to supplant other private sector investors. It's to provide something different, something that the market doesn't offer, to take risks that private investors won't take. So what we try to do, we look for opportunities where we can, A, add value from IFC's perspective in terms of stamp of approval with an international investor. We work on corporate governance that Wael mentions, typically is a weakness in many of the companies that we see. And we try to bring something that other PE firms may or may not be able to offer. But I think fundamentally the distinction is we use private equity, we use equity investments and all of our investment products as a tool to promote development versus as an end in and of itself.
Excellent. Well, I'll go back to you. And we all know that investors were tired during the last years from the low rate of return that we've seen in developed countries. And more of investors are going towards developing countries where the interest rates, the rate of returns are higher. Now, in the recent months, we started to talk about frontier markets, investment in sub-Saharan countries, even Abrash Capital, they are doing investments in Latin America. What is the state of the market in Lebanon? What are the industries that are being attractive to investors or on which we should bet for the coming years?
An honest answer, we cannot talk about an industry situation in Lebanon in the PE. We are still, like Mr. Hneine said, this industry is still very nascent. That's why it's very much opportunistic. Where you find a good deal, a good company that basically fits part of these criteria, you jump on the deal and you do the deal. However, we can say that F&B in Lebanon is a vibrant sector, and it doesn't come as a surprise because, as you know, Lebanese are excellent in developing new concepts and exporting these concepts to the Gulf and sometimes to Europe, especially Lebanese concept. That's why Kababji was one of those examples that we jumped and basically made a deal with this company through a leveraged buyout, and with the purpose of growing this company east and west and exiting in 6 to 7 years. Other industries like the education sector is also very competitive, especially that also Lebanese managed to transform education into a franchise. Sabis is a very good example, and other examples that are successful concepts that are growing all over the world. Other industries that are private utility companies, example water companies, are also successful and they can present growth opportunities. Healthcare technology is also one of the sectors that are also vibrant in Lebanon. Technology in general, but we see that this is more captured at the small side or startup companies. But in general, although these are my findings, but I don't think we can talk about an industry and really qualify this industry before 4 or 5 years to take some shape.
Wassim, how about you?
Yeah, Lebanon is too small to have a country-specific fund or a sector-specific fund. So, and the market is small, not only for private equity, but also for companies. So the key word that Wael has said is export, whether it's technology export, F&B export, FMCG export, because you need to grow. We're not Egypt. We don't have 90 million people. We have only 4 or 5. So we privilege companies that can give potential for outside Lebanon. Last deal we've done, for example, in Hazmiye, it's through Hazmiye Backyard. It's true that it's a local community-focused project, but we're looking to replicate the same concept abroad in MENA. So this is the benefit of this deal. We're looking into an FMCG and an IT company in Lebanon that already have presence outside, and the business plan will be mainly derived from outside Lebanon.
Excellent. Tom, compared to private equity, you invest at different stages in the life of companies. What are the industries? What are the kind of companies to which you're providing support?
Right now, we have been looking at a number of sectors over the last 3 or 4 years. We're invested heavily in the financial sector, which is one area that PE firms typically don't invest. If you notice in Wael's graph, banking sector, that IFC is a major investor in banks worldwide. We have equity investments right now in Bank Audi and Biblos Bank. And many people ask me why. And I think it's pretty simple. There's a couple, really 3 key aspects of those types of big ticket investments. And one is those are very systemic banks. So the more support that these major banks can have in Lebanon to deal with some of the risks that Lebanon presents these banks, the better off the entire system is. But I think most important, it's the opportunity to help them grow beyond Lebanon, which is something that Wassim mentioned. You know, what we want to do is work with some good banks in Lebanon and take them to other countries. We're working with, for example, Bank Audi in Turkey, which helps solidify inter-regional trade, again, which is part of our developmental story. On the small side, we've done investments in the IT sector. We did one investment, which was mentioned earlier, MobiNets. And that's a small IT company based in Tripoli. And I think that's a situation that really demonstrates sort of the flexibility that IFC has. If you look at when we invested in that company about 3 years ago, it was primarily owned by one individual. There were no institutional investors. And at that point in time, they had really had their main product was post-prototype. It was very early stage for IFC, But we felt at that time, given the opportunity to help a young company sort of gain attention by having IFC invest in them, by helping it build a board of directors, which it didn't have, providing it advice in a number of different areas in terms of environment and social and governance structures, all those issues that IFC can bring, that we could help prepare that company for additional funding rounds, which ultimately it has now had 3 additional rounds of funding. So I think there's a situation where on the small side, a $2 million equity investment at a very early stage shows one aspect of what IFC tries to do. On the other hand, we have larger investments in financial services. In the middle, we have about a $15 million investment we did with Butek, which is owned primarily by the Yunus family, based in McAllis. What they wanted to do when we came in, they were looking for an institutional investor, and IFC is often seen as quite an attractive first institutional investor because we can help, again, prepare the company for pure play PE firms. They were looking to go regional, so we could give them some access to our contacts within the region. And at the same time, we can provide some political risk mitigation for companies that are going beyond their borders because of our part of the World Bank Group and our relationship with governments and regulators and so forth. And then we also have investments in the retail sector with ADMEC, which has the Monoprix and the BOIL12 franchises. So we don't have specific sectors. What we try to do is look at where we think we can add value and where we think that the company's growth and success will help the countries that we're operating in.
But do you have a specific ticket size? Do you have a specific hurdle rate of return that you set within your models?
Nothing with IFC is cut in stone. If you look at ticket size, I'd say right now our sweet spot would be somewhere between, say, $10 and $20 million. We'll never be more than a 20% shareholder. We want to invest in other people's companies. We don't want to be the major investors. Like PE firms will take significantly more share of a company than IFC would be. And that's part of our mandate. We're supposed to facilitate other companies' growth. You look at hurdle rates. We don't have a set hurdle rate like you saw the other firms. But what we try to do is we try to balance off the risk we're taking with the return that we would expect, but also we factor into that the developmental impact. Again, if you look at a return on a bank Audi investment, it's going to be very different than a return on a small IT company. And the risks are very, very different. So we are, I'd say, a lot more flexible, by and large, than a pure play PE firm. Our holding period is more flexible. We don't have the obligation to sell within 7 or 10 years with a finite fund. We finance our investments off our balance sheet. We tend to be counter-cyclical, so when the market is bad, we tend to try to step up, and that's part of our role. The private equity firms are investing heavily. IFC is not as attractive. Now, when private equity firms back away because the risks are changing, the market's down, that's when more companies are open to IFC investments, and we actually can price our investments better. And if you look at the last 10 years, our portfolio of equity investments globally has really increased. For the first 30 years of our life, we were primarily a debt house. And over the last 15 years, we've been pushing heavily into equities, and our returns as an institution, we're making $1.5 billion to $2 billion a year, and a significant portion of that is driven by our equity returns. So we try to be flexible, we try to see what makes sense for the market, and we try to see where we can play a role. And that may mean we are more flexible on returns and ticket sizes, but we just try to be a bit practical in terms of what we're trying to achieve.
How about you? How about your... we usually say, sophisticated investors at least, they have this motto, A team, B product, better than A product, B team. So what is your investment strategy, and what do you look for in your investment in terms of entrepreneurs, businesses? What is your investment philosophy?
We are very much driven and affected by the appetite of our investors, because at the end of the day, the strategy that we are following is that we are investing on company by company basis. We are not having a general fund that is funded and then you go look for opportunities to invest in. This means what? This means that every time you have an opportunity, you have to go and talk to the high net worth individuals to convince them to come into this fund. This brings me back to my first slide. The requirement is return, sustainability, good potential for exit, marketability. These are the things that I have covered in my presentation are exactly what we feel we need at this stage. Of course, we have very strict ethical policies in terms of what we invest in and what we don't invest in. This is, of course, something we respect. If we, of course, supporting any middle market company in Lebanon is a very big contribution to the economy. So everything goes back to the main point. Bottom line, we need to be able to drive investors and high net worth individuals into our funds. And these investors are always presented by very competitive products and very competitive returns in various places around the world. Especially high net worth individuals are international investors. They are not Lebanese investors. So they are presented by opportunities all over the world. So that's why we need to be able to be competitive. To be able to be competitive, we need a company with a competitive advantage, and sustainability is key, exit is key, etc. So really, I go back to what I have presented earlier. These are our requirements as we see them now.
How about you, Wassim? What is specific in your investment strategies?
Well, we're very clear. We're raising a $100 million fund for the MENA region. Investment ticket is $5 to $10 million. Target is to have strong minority stakes, not a majority. Industries, we're sector agnostic, so we're generalist. We want to exit in 5 to 6 years. Would generate 28% IRR, hopefully. And we cover the MENA region as a whole. Usually, we don't prefer real estate or startups, but we do them outside the fund on a deal-by-deal basis if we have something interesting, and no turnarounds or distressed or whatever.
Excellent. Well, you talked about the 220 model. How about the pay in Lebanon? How does it apply? Are we following the same performance fee structure?
Absolutely. This is exactly the structure we're using. Depending on the company that you're in, example, like I said, I forgot to mention real estate. Of course, real estate is always a component of private equity in Lebanon, and our investors, they're used to do that. So in real estate funds, you might choose to use 1% management fee rather than 2%, because the management involvement is less than another company where you are a majority owner or you have to contribute a lot. So it all boils down. The management fee is a cost. So private equity companies look at the management fee as a cost with a marginal profit. This is not where the profit comes. The profit comes from the performance fee. The performance fee, the 20% after a certain hurdle rate of, example, 8%, that's the hurdle rate that we have used in previous cases, is very common, and we never felt our investors are accepting that very easily, because at the end of the day, they want you to work, they want you to perform, and if you actually realize the exit, they're happy to pay you the 20%. They resist a little bit on the management fee, but again, it depends on the industry and the level of work that you want to put. But that's not a profit area, that's a cost area. You cover your cost of management during the holding period.
No, usually it's 2%. We're a bit more expensive. It's 2%, the international trend, but probably Wael is referring to real estate private equity, which requires less interaction. But for normal private equity, it's 2%. The 220 rule, so it's 20%, 22% management fee, 20% performance with a hurdle of 8. These are the magic numbers of the.
Excellent. Tom, IFC is known to be a promoter of best practices. All over the world, in all the offices, this is what they claim, and this is what you try to do. What are the best practices that you're trying to bring to companies in the region?
I would think the first and foremost is around corporate governance. I mean, what we're trying to do is identify good sponsors who have the vision, but oftentimes, especially at the earlier stage in the middle market, they often tend to be family-owned enterprises. And at that point in time, they really need to have proper governance structures, accountability frameworks in place. That's something that IFC can bring. We have teams in the region and globally that can come in and do assessments and work with management and owners to help them transition from a family-owned enterprises to one that treats minority shareholders, properly, that is transparent, that is addressing all the issues that Wael mentioned earlier about taxation and double books and so forth. I think the other area that some people and companies, I think, shy away from IFC because of it, but the companies that actually embrace it really see benefit and surround the environment and social standards that we set. We're looking for companies that really want to be a leader in these areas, and we really think that increasingly the environment and social risks that companies are facing need to be addressed. And if they're not addressed, then the long-term sustainability of those companies and those cash flows and those profits can be at risk. So what we want to see is companies that are willing to invest in their people and their systems and really want to set the bar quite high in terms of how they manage their employees, how they deal with the community, and how they deal with the environment overall. So I think in those two areas are probably where we really try to push the envelope. And we think that by IFC requiring and working with companies, not necessarily to present us best practice when we invest, but be willing to make the changes necessary and that we agree upon to move that company towards best practice in the context of the environment they're working in a reasonable way. And really we want to share that vision with them, and we want the owners and the management team to share the vision that we have about being best practice and making sure that we are operating with integrity both inside the organization and within the community more broadly.
Excellent. What?
We own a consulting company in Lucid. And this consulting company is a management consulting company that is focused on strategy and implementing management best practices. So in fact, we before becoming investment bankers, we were corporate finance advisors and management consultants. So in fact, this is our business at the core. So we have a lot of added value here. We can help companies implement a corporate governance. We can help companies fix their financial systems and accounting and reporting systems, choose the best technology. We can help companies establish proper boards, proper authority matrix. We can help companies recruit the right staff, the right managers, and also to recruit independent directors at the level of the board, which is something new, and people now we're feeling that companies are more open to do that. Most importantly, this consulting company is specialized in formulating strategies, and this is the added value. That's what I meant before, that when we see a company with an X factor, it's enough for us. Really, maybe that's the most important thing that I want to say today. It's enough for us to see a company with an X factor and everything else almost missing. We can assist the company to capitalize on this and establish corporate life, best practices, and help it all the way to be ready to be fundable. And after being fundable, we will work during the holding period of the private equity fund to create value until exit. We have helped companies in exit planning. We have helped companies in formulating their strategies. We have helped companies in developing their organizational structures, policies, procedures. We have done that since 10 years. We have done more than 100 companies regionally, varying in size and industries. So this is a sweet spot for us, Dr. Chahine. And we that's why when we come to companies, we say it's a one-stop shop. We're not just coming to put money and wait for return and wait for the report at the end of the month and ask questions. No, we roll our sleeves and get to work and help you create this value.
I still have many questions to pursue the discussions, but I guess we have some questions in the room. Please.
Good evening, Chairman from IMAS. You said about you supporting consultancy and auditing. This is the cost of cost management or consultant fee, or it's free of charge?
That's a very good question.
No, of course.
Supporting the companies, this including the budget or separately services?
No, if it is part of a banking deal, usually it comes as a support. But if the company is not ready to be fundable, so there is no capital finance transaction involved or no buyout involved. So in this case, it is just a pure advisory contract that is signed between us and the company to help achieve a certain turnover. Of course, the costing varies between a company that is just coming for the service or a company that we are helping in order to make a deal with and to continue at the other stages.
Excellent. Do we have a
question also?
Please.
You said, Mr. Wael, that your companies look for companies after they study each company aside. You are looking for these companies, or the companies ask for your funds issue?
Both. Some companies are proactive and they come forward and they approach us, and they have done that before. But in most of the cases, we look into companies. We scan the market. It's not easy because many companies who they don't know that they are ready to be fundable. They don't know that there is a huge added value by having a strategic partner that I can help them go to another stage or grow into or enter another market, etc.
Because most of the companies in Lebanon are family business.
Exactly. There is a slide that I wanted to share with you, which is this one, and this is an amazing slide prepared by inventors for the Ministry of Economy. It's the Lebanon SME Strategy, and this refers to the first question by Dr. Chahine, what are the challenges and how we can grow this market. We really need to answer all of this. So at the center you can see the culture, like you said, okay, the mentality, but it's changing, especially with the second and the third and fourth generation families. They're changing very quickly. And then at the second level, which is at the enterprise level, at the industry level, and of course at the national level, we have issues everywhere. But these issues are identified. We expect some progress here, but as you have all heard from the previous presentations, we have far bigger challenges at the national level. That's why we are trying somehow to count on ourselves to work with these companies and create values.
One more question. What will happen if we didn't find a buyer at the time of exit? This question. And the same question, what will happen if the company didn't make growth 3 times after 5 years?
Okay, first for the buyer. That's the most challenging task for a PE firm ever. And that's why I was saying we want to enter the process with all of this in mind. Okay, we don't want to be surprised later on that this is not ready or the market is not ready, etc. Usually we study very well the exit strategies well ahead of investing into in any company. There are many exit strategies. One exit strategy could be trade sale, a simple trade sale. That's why the companies that we look into are usually sought after by bigger groups for all sorts of reasons that we have mentioned. That's why when I mentioned all these reasons and the type of buyers, we know who are these buyers. That's why we maximize the chance to have a trade sale. The second possibility is always an IPO, and I don't mean Lebanon. That's why, because today the public capital market in Lebanon is not ready. It is taking shape. The CMA is making big progress in that direction, but we are still not ready. But companies with regional expansion or European expansion, we could see cases of companies listing in Dubai or listing in AIM in London, the AIM exchange in London, and there are other markets that are developing around the world that basically we can use. A third way that you can use is to roll it over into another fund. This is also another possibility when you don't find a solution. Technically and legally, there are always solutions for these things, because at the end of the day, a fund is owned by its investors. So at exit time, at maturity of the fund, the investors should meet and decide what would be the next step, and there are various ways to figure it out. Your second question was...
if the company didn't make growth 3 times in 5 years?
It's not, when we assess a company, we can tell if this company has the potential to grow or not, with our help, of course.
In Lebanon, we have a certain problem, we don't know what will happen.
Absolutely. You just have to do your best to do that, and you should basically think about various ways to diversify your revenue sources. You cannot count, that's why all the deals that we have done, maybe this is the first time I'm saying it now, all the deals that we have done in Lebanon are for Lebanese companies based in Lebanon, but all their expansion is outside Lebanon. And once you have companies like this, you are diversified enough to move from place to place. I'll give example Kababji. Kababji is a company that we bought it. We bought a majority stake in it, and the plan is to grow it east and west. East, I mean the Gulf and all the other MENA countries, Asian countries, European countries, US. So you are very much diversified. If you have an issue in a certain region, you have to switch to another region. These are all components that you have to think about while making your decision, not in the middle. You shouldn't be that much surprised. So these cases are usually signs of ill preparation, let's say, or lack of preparation, or lack of analysis.
Excellent. Do we have other questions?
You're saying some company can expand and list shares outside Lebanon. This is against the conditions of Circular 331. According to BDL initiative, the startup must be Lebanese and established in Lebanon. For this reason, to improve the size of the market in Lebanon, I think it's very important to have a well-established and dynamic stock market, because Circular 331 necessitates that shares should be listed on the Lebanese stock market.
Absolutely, but I don't know if you missed this at the beginning. We are not talking about 631 at all. All the funds that we are talking about, these are a regular, normal private equity fund funded by high net worth individuals. They are not funded by banks' money, so they are not linked to 631 whatsoever. So this is what we are covering. For 331, you're right. For startup companies and the knowledge economy, you're right. There are some conditions for obvious reasons, and of course we encourage that. But everything we're covering today is for the middle market by normal private equity. That's why I said also we are asking for another 331 version for the middle market. But then when something like this happens, then of course you have to stick to the regulations. But what we are discussing here are free, regular private equity, not linked to any regulation whatsoever.
I have another comment. You're saying in your presentation, the size of the PE industry in Lebanon is still small. You said we don't have yet PE industry in Lebanon. And the reason is we don't have enough money to be injected. I think the contrary is true. We have enough available money to be injected into new startup. But the reason is we don't have deals. We don't have opportunities. And I think the money available for new startups is more than enough. Yani we have more money than we have opportunities.
No, absolutely. I agree with you. Maybe there's a misunderstanding on this. Definitely there is money, and definitely the challenge is to find the right deal to invest the money in. Absolutely.
Can you have an estimation of money available in Lebanon at the present time? Including the 400 million by BDL initiative.
The 400 million by BDL initiative are completely outside of our scope, because our scope, as I said, is based on raising money from high net worth individuals. That's why it's very hard to estimate the size. The size can be very big or can be very small. Again, like you said, rightly so, depending on the deals. Why? Because who are the investors? The investors are high net worth individuals. The profile of a high net worth individual, he or she is an international person. It means they have accounts in Switzerland, and probably they have accounts in London, and they have portfolio here and portfolio there. That's why this portfolio can move from places. Example, we managed to pull money from the investors the investors that invested in our fund regarding example Kababji. Part of that money, probably 1/3 of that money, was outside Lebanon. It was not part of this space of investment space. We managed to convince these investors through our RMs to come and invest in this fund. So they transferred money from outside Lebanon to invest in this fund. That's why I don't have an estimate for the size of money available for private equity, because it's not defined as such. The size could be huge, but again, the key is to find the right opportunities. That's why we chose not to do a fund for Lebanon, a general private equity fund for Lebanon, and to go deal by deal when we find the opportunity. So when we find a company, we try to make the deal, and we raise money for that deal. It's under a fund structure, private equity fund structure, Cayman or any other jurisdiction that is well supporting these structures, and then we make the deal.
Excellent. Tom, go back to your presentation about IFC. What is your equity strategy going forward?
I think what our strategy for the next 2 or 3 years really is trying to find opportunities in the real sector. As I mentioned, we've got quite a bit of exposure in financial markets now, so I don't really see a whole lot of new appetite in that space, in the equity. We've got a couple conversations now in the healthcare sector, and in it's financial sector, but it's not kind of a technology play. And I think what we really want to do now, given the challenges that Lebanon's facing, is look to be the investor of choice for some of these companies that are growing and taking advantage of the 331, and they get to the point where they need $5 to $15 million. That's where we see IFC coming in more. And I think some of the key areas, we really want to look for companies that have an appetite and a vision and a scalable model that can take them beyond Lebanon. And I think that's what Wassim pointed to. It's not that easy. I mean, a lot of the companies we've spoken to over the last, since I've been here in 2008, I've seen a bit of a change, but because a lot of the companies are family-owned, they still haven't really bought into this idea of having an institutional investor and seen the real value that an institutional investor can bring. So I think that's one of our big challenges. We're bullish on Lebanon. I mean, we want to find deals. And our appetite would be, we could do 2 or 3 deals every year in Lebanon, and good ones across in education, healthcare, services. That's probably where the spaces that we'd be most interested over the next 18 to 24 months.
Thank you. Wassim, where do you think the private equity industry will be in the coming 5 to 10 years?
I think the only way is upward. As I said, we're looking into 2 deals in Lebanon today. One is an FMCG and one is in IT. They're both very interesting deals, and we are in due diligence. So, and we're looking into other deals in Egypt as well. But for Lebanon, I think we have a good pipeline.
Excellent. Wael?
I agree with Wassim. It's growing at a slow pace, but yes, definitely it's growing, and it's getting more organized and more sophisticated. And I can see the whole investment banking practice in Lebanon is gaining momentum. And for many reasons, this was put aside, although the law of investment banks in Lebanon is very encouraging because it gives exemptions from tax over 7 years and many other encouragements for investment banks. But it was until probably 2 years ago or 3 years ago that we started seeing real investment banking activities. And this is due to the strict follow-up by the central bank. And because investment banking activities are going to drive the private equity in Lebanon, because investment banking deals are the source of the private equity, because again, like the gentleman said, it's the deal that we need. So we started seeing a change in this. That's number one. Number two, we started seeing a big change at the level of family businesses. They started becoming more open to have investors with them. And the good point, which maybe we didn't cover today, is the difference between direct investment. Let's say a person coming to invest directly to take 20% or 30% of your company, or a private equity managed by a professional private equity firm or investment bank taking the share. We are seeing that companies are much more open for private equity companies because they don't see ego involvement in this. They see just a professional company coming just to add value and exit in 7 years. Whereas a private investor or a strategic investor coming into a company, nobody knows after certain years what would be the objective of this person and what would be the dynamics and the relationship in the board and the ego and the authorities and etc. With private equities, there is no ego. Companies see that directly, and they are open to receive us. So that's why, all of these elements, in addition to what Wassim mentioned, will contribute very positively, and we're going to see some increase in PE activities in the coming
It's always better to deal with professionals.
Absolutely. This is a game that requires knowledge at the level of strategy, management, legal, operational depths. That's also very important. A fund without operational depth has no value. So operational depth is crucial to be able to add value to the company. All of that put together with the financial and banking, this is value. To find all of this in one person without ego consideration is very difficult.
Excellent. Do we have other questions? Please, we have two.
How do you draw the line between the two? Thanks.
I have another slide for that exactly to answer your question. The answer is no. And it's very difficult. When we did the deal and I said leveraged buyout, yes, we worked with one bank in Lebanon. It's the sponsor of this conference. And they extended leverage for the fund. Okay? But not all banks are that open-minded and that business-oriented. That's why we have all these issues. The private equity in Lebanon is facing all these issues when it comes to financing, starting with commercial banks that are not ready to fund at EBITDA multiples. If you go to the UK, you have a proven EBITDA, you can get 4, 5, 6 6% depending on the industry. Immediately after 2 or 3 years, we have approved your cash flows. The market of mezzanine financing in Lebanon doesn't exist. Issuance of bonds for acquisition, so acquisition financing is also very weak, etc. So, yeah, I hope this would answer your question.
That initiative happens, maybe it solves the problem, right? When you're mentioning about getting the central bank to support the market. Just like the 331. The central bank supports the bankers to extend more loans to private equity. Maybe it can help the whole industry to grow.
The 331, we really hope we can have our own version of 331, but that would help on the equity side. On the debt side, this has to do with the mentality of commercial banks in Lebanon, who are used to another form of financing which based on real estate mortgage and other considerations.
I'm sorry, I missed part of your question. Could I ask you to repeat it and just speak up a little bit louder?
The question is, when do you differentiate between going in as an equity investor or debt investor in Lebanon?
How do we decide which...
Yeah, which side to take?
Basically, it comes down to two issues. I mean, if you have a company that's got a very good growth story and probably a weak cash flow story, that's going to be an equity investment for us. If you have another company that's got a very stable, predictable cash flow and not much of an upside, then we'd rather be on the debt. I mean, it's pretty much straightforward. Now, in Lebanon, given the fact that most of the banks have liquidity and you can get 5 to 7 year loans, pretty easily in Lebanon for, good companies, we don't do a lot of straight debt. I mean, one thing we can do, though, which most companies can't do, is that we can do anything between straight debt and straight equity. So now the PE firms are a lot more flexible, but the banks will give you plain vanilla debt finance. But if you need a convertible or you need a participating loan, if you need something that's a little bit off color, that's where I think the PE firms, to some extent, and to a great extent IFC, because we tailor each investment to the needs of the company. And we try to see what makes sense in terms of what they need in terms of financing and how we balance the risk and return and the relationship. Because another thing that IFC is very keen on is having relationships we can do multiple deals with companies. So we may go in with debt to begin with, but we may have our eye on an equity investment later down the road once we get more comfortable with the company. Or in reverse, if it's a smaller company, we may go in with debt at first. Once it gets more stable cash flow, then instead of having to go outside for financing, we could finance it another time or bring some of our other partners in. So really it's a question of the product is really a question of where that company is in the stage of its life cycle and really its cash flow predictability.
How challenging is it to offload the equity investments here in Lebanon?
I'm sorry?
How challenging is it to offload your equity investments when you want to exit? I mean, capital markets are not there. Strategic buyers sometimes are difficult to find. In your experience, how did you actually exit most of your investments, if you ever did?
I'm sorry, I'm missing.
What is your exit
strategy for deals that you made in Lebanon?
Sorry. I mean, basically our exits here, they're kind of generic. Everyone looks at an exit, and you do think about that going in. I mean, you don't go into an investment without thinking about the exit. Now, given that we're more patient because we are investing off our balance sheet. We don't have a closed-end fund that has the time pressure of 5 or 7 years where you pretty much have to get out. And there are ways around that, but there's a lot of pressure on PE firms to get out of deals. IFC can actually be a lot more flexible. A typical exit time period is between, I'd say, 7 to 10 years. And what we try to do is we time that exit based on where we think we can get a decent return and once our role is completed. Now, back to specific types of exits, we would like to IPO when there are opportunities to do that. And a lot of the markets that we operate, those are few and far between. In a place like Lebanon, the market's thin, so really an IPO on a Beirut stock exchange is not something that we would, put a lot of hope on. Primarily what we'll be looking at, I think as Wael said, is trade sales. And we go into companies where we know that they're in a sector or they're in a geographic space where other parties would have an interest in. And I think the Arab world is a good example where you have successful companies in North America or in Egypt or in Europe who want to get a foothold in the Middle East, but they don't want to start from scratch. It's a lot easier for them to come in and buy someone who's already created value. Look at the Maktub sale to Yahoo is a perfect example, where for Yahoo to come in and build an Arab platform would have taken them a ton of money and a ton of time. To come in and pay a good multiple for Maktub, I mean, that's kind of what we'd be looking for, and I think everyone recognizes IPOs are great when you can get them, but they're few and far between in reality. So trade sales are much more likely exit. And sometimes we'll structure a put back to the owners. Now, if we think that the exit is too uncertain, in some cases we will make that a requirement with some type of estimate of a multiple or some valuation algorithm that, you know, within 3 to 5 years we want out if we can't find an alternative. But we try to be reasonable again in terms of what we can expect from companies, because ultimately our role is not, you know, we're not necessarily profit maximizing corporation like the PE firms are. I mean, we want to get the most out of our investments. We want to prove to other private investors that you can make money in emerging markets. That's really what we're trying to demonstrate. But at the same time, we're willing to take a slightly lower financial return if we can get that sort of developmental return really strong. And we're constantly weighing those two returns.
Thank you, Tom. I think we had a question in the middle here. Please.
Good afternoon. Based on what you said, Mr. Wael, the expectations for returns are usually 20%. Now, we don't have substantial statistics on exits because pretty much most of the PE deals that you've done were in the last years, right? So still no exit. Based on the performance of the companies and the industry and the Lebanon, do you foresee us changing our minds and decreasing pretty much this 20%, or you still are predominant on this figure pretty much?
The problem with the 20% is not very much linked to exit, although it should be. But investors, these are investor preferences, actually. In some cases, you can get, investors can accept to go in at 15% probably, but in some very specific cases that we can discuss on case-by-case basis. 20% is usually a natural and logical inclination to any investor, because at the end of the day they can go to and invest in S&P 500 and they know they can sleep on their money for 5 or 6 or 7 years, which is the holding period of a private equity, and get to 9.6% on S&P 500, and they can sell it anytime and they don't worry about exit. If you have this challenge in front of you, how can you convince an investor to accept joining a fund, investing in a fund, locking his or her money for 5 to 7 or 10 years without the decent return the way they accept it? This is number one. Number two, there is also a market. As I have seen, most of the funds available in the MENA region, they're offering returns. The lowest is 15%, and these are in countries that have basically much better risk rating than Lebanon. And then you have 20 and 25 and 30%, if you go back to the slide. So in this world, it's very difficult to convince investors, because at the end of the day, there are two aspects that produce a deal for us. A good deal, a good company that you can invest in, and investors that are willing to put money in this deal. This is very clear. And it's market supply and demand and market prices. And we try to push down as much as possible in order to make it easier even for us as fund managers. But I cannot say that this is going to be an easy task. Now, if we are talking about example, the private equities that we are trying to structure are not only in Lebanon, because we cannot make a living just out of the deals that we're going to structure in Lebanon. That's why we follow the Lebanese diaspora around the globe, and all the successful people and the family businesses that they have, promising businesses, etc., in Africa, in the GCC, and in Europe, etc. So in Africa, for instance, I cannot make a private equity fund with less than 25 to 30% return. Because again, the risk is huge, but then the growth is huge. Not in the last 2 years with all the issues they're having, etc. So this is market prices. These are not returns that we require because we want to please our investors. This is the price at which we can bring investors into our funds, depending on the region. Now, if you have a fund in Saudi Arabia, for instance, you can get away with 13%. Example, return. So why? Because the risk is perceived differently. So it really depends in which market you are. In Lebanon, 20% seems to be a requirement by most investors.
Just concretely on the 3 deals that I can think of, one of them is above 20%, and two above 20%, and one above 15%. So that's actual return. So it happens.
The actual return?
Yes.
The exit?
Yeah, I mean, yeah. If you read the news, there are exits happening.
Do we have other questions?
For example, FNB deal, the IBL deal, there is a Sudamco deal, and there is the Shadid deal that was exited by Eurobina.
Excellent. Thank you very much. Do you have other questions? Great. So I've noticed one thing. We did not have questions about the role of the regulatory body, the institutional framework, and that was as per the recommendation of Mr. Ramzi Al-Hafiz. We should operate no matter what. I'm sure we learned a lot from our guests. Thank you very much for your presentations, your contributions. We all know more about the private equity industry.